This video will discuss the borrower capacity element of the financial assessment required to qualify for a reverse mortgage. The borrower must show capacity to meet their contractual financial obligations and their monthly minimum living expenses. A reverse mortgage does not require a monthly repayment, and opting not to make a repayment does not impact your credit score. A traditional mortgage requires an income level 3 to 4 times as large as the monthly repayment. This is because traditional forward loans require monthly payments, and failure to make those repayments can lead to foreclosure. A federal housing authority reverse mortgage only requires you have a stated minimum residual cash flow left over after you meet your financial and property obligations. This standard is much lower than monthly income required on a forward mortgage. In general, you must have between $600 and $1,160 of monthly residual cash flow, depending if your family is from 1 to 4 or more in size, and amounts do vary slightly depending on the region you live in. For example, if you have 3 dependents living in the home with you, then you would need to have approximately $1,160 of leftover monthly cash flow. This would be the cash flow left after all your required debt repayments have been made, and you have set aside the monthly estimate of all property charges, such as insurance or property taxes. If you do not have sufficient income, do you have any savings? You can use those savings to add to the monthly income. We spread those savings, which are after tax, if the savings are in retirement accounts, across the estimated remaining life of the youngest borrower, and add that cash flow to monthly residual income. For example, if you're 70 years old, we expect you will live another 15 years on average. If you had $100,000 in IRA accounts, we would deduct 30% for tax and spread the balance over 180 months. Which results in $389 per month as a credit to the residual income requirement. If you have no savings or they are insufficient, then we see how much of the reverse mortgage is available and unused after you have paid off mortgages and other liens you are required to. We can spread that unused balance over the remaining life to help with the residual income calculation as well. If you are still short on the income required, then we can look at the number of dependents living in the home with you. Minimum residual income is a function not only of the region, but how many dependents are living in the home with you. If any of them have monthly residual cash flow more than their required minimum, we can remove them as a dependent and reduce your required residual cash flow. As you can see, there are many ways to help you, and there are tools on this website that can answer many of your questions. It's important to discuss all the options with your lender.